And then one more topic that's in the chapter, periodic versus perpetual inventory systems. Okay. Um, in a periodic system, the inventory is not tracked in an accounting system continuously. So we talked about how businesses have their point of sale systems where they scan the item and they scan it when it comes into the warehouse, and they have a very sophisticated uh, inventory management system that's tracking everything kind of real time. Not all businesses have that. Um, like a small business, like a small retailer, they're not gonna maybe invest in that level of sophistication. And so maybe what they're gonna do is just do physical counts at the end of each period. And my family owned a Radio Shack, and we used to do this. This is like my job as like a seventh grader. I would just at the end of the month, I would be given a list. It was a printout of like how much stuff we have in inventory as per the system, and then I would just go and physically go to the shelf and count. And it was often like, you know, most of the time it matched up, but sometimes it didn't. Okay, so that's an example of a periodic inventory system. It is not as accurate as a perpetual, um, and I'll show you a little example of why that is. Um, but you basically have a certain, like, it's like slightly different accounting. You're gonna kind of track your purchases, um, and you're gonna have your sales, and you're gonna have your ending balance count at the end of the period. And between all these things, you're gonna get your cost of goods sold, and it's kind of like you're gonna put this here, you're gonna count this, you're gonna know how much you purchased from your vendor, and you're gonna use the beginning balance, which is the ending balance from the last period, and you're gonna use that to calculate this cost of goods sold. Okay, so it's kind of what I showed you in that last thing. Now let's talk about why it's like not as accurate as the perpetual. So we have these two scenarios. Um, we have a starting balance of 10 units, and each unit costs $5. We have a purchase transaction, and then we have a sales transaction. In this second scenario, it's the same thing, except the orders are reversed between these two. Okay, we first have a sales transaction and then a purchase transaction. Okay, so you're going to see that under the perpetual system, it's going to give you two different results, but under the periodic, these are going to give you the same results. Under perpetual, okay, so actually, well, yeah, do the calculation. This is, I guess, my intention here. Your job is to calculate what is the cost of goods sold and the inventory values in each scenario for perpetual and periodic. So under this, you're going to have some cost of goods sold and inventory for the perpetual versus periodic, and then the same thing here. Okay, and you're going to see, again, I'll give you a hint. You should see that under the perpetual, it's two different, uh, you'll have two different values, but the periodic is going to end up with the same. Okay, and they both use LIFO. So see if you can come up with that. So you're starting with 10 units, you're buying 5 more. So how many do you have? You're not 10, it's not 10 times 5. It's 10 plus 5, right? It's like you have 10 cars, you buy 5 more cars, and then you're selling 3 cars. So how many do you have total? 12. Okay, so we have 12 units. So under the periodic, um, you're gonna have these 12 units valued at, basically the first 10 are gonna be at $5, and then the next two will be at this. Okay, because we would have expensed the the newest items first. Okay, so under periodic, it's going to be uh, 10 at, so 50 plus 12. So that's $62 inventory. And so what we would do is we take the beginning balance, $50, right? 10 times 5, plus your additions, which is $30. minus our ending balance of $62 equals our cost of goods sold, which is what? 80 minus 62 is $18 cost of goods sold. Okay, so $62 inventory and $18 cost of goods sold for periodic. For perpetual, we would have had a T account. I'm just going to do the T accounts. For $50 of inventory, the purchase transaction would have been 30, right? The inventory. And then sales transactions, 3 units. Our cost of goods sold, in that case, would have been taking 3 units from the latest one. So 3 times 6 is $18. I would have had a debit to 18 and this 18. So then what is it? 80. Yeah, so it's the same, 62. Okay. So in scenario 1, our periodic and our perpetual give us the same answer. Okay. $18 cost of goods sold, $62 of inventory. Okay. Now, scenario 2 is going to be different because under periodic, it's the exact same. There's no change actually. Okay. Because we only kind of figured out that we have 12 units at the end, and we're going to basically start the valuation from the back, which is still in this case 10 units at $5 and then 2 units here, right? So those 12 units are going to be $50 plus 12. It's the same for periodic. Okay. Now, the problem though is that in perpetual, we are doing a real time kind of thing, right? So at the time of the sale, we have not yet even purchased these new items, right? So in the perpetual, it's basically going to be, we start off with 50 in inventory. This sales transaction, these 3 units, we cannot account for this because it hasn't happened yet. We have to look at just at that time of the sale, what was in our inventory. Okay, so it's just these $5 units. So these 3 units, it's going to be cost of goods sold 15, debit 15 here, and then we buy these $30 units. So 80 minus 15, this is 65. Cost of goods sold is 15. Okay, so in scenario 2, because the sales transaction happened before the purchase transaction, which is correct, I mean, that is actually the correct way. Like, that's more accurate. The perpetual system is going to give us a cost of goods sold of 15 and an inventory balance of 65. Okay, and again, the periodic is the same between these two scenarios because we're only looking at the ending balance. We didn't care of the order of things. We're just seeing what the net balance was in terms of number of units, and then we do our valuation based on the purchase transactions that happen. Okay, so that's not right. That's why a perpetual system is preferred, because it's not going to capture the order of things, which does matter if you want an accurate cost of goods sold. Again, periodic, exactly the same calculations, because again, you're only looking at the beginning and ending. Perpetual, the order of the transactions will matter, okay? Which that detail gets lost in a periodic system. So that's why it's like not as sophisticated.